Are you fed up with living from paycheck to paycheck and don't understand how some people seem to get rich so easily? Could I tell you a step-by-step plan to not only make more money, but also save, spend, and keep your money safe for the long term? We will show you the easy ways to get rich in this video, no matter where you are economically. Although accumulating wealth is not a simple or quick process, anyone can succeed financially with patience, hard work, and self-control. The good news is that you can develop and protect your wealth over time with a variety of ways. You can gradually increase your wealth by adhering to important guidelines, including goal setting, debt management, prudent saving and investing, and reducing the impact of taxes. Your chances of success increase with the earlier you start putting these techniques into practice. The fundamental processes to accumulating wealth will be covered in this course, including earning money, creating financial objectives, investing and saving, safeguarding your assets, and establishing a solid credit history. Let's examine each of these elements in more detail, because they are all essential to achieving long-term financial success. Make money. Making money is the first step towards accumulating riches. Even though it might seem apparent, this is a fundamental principle. You cannot invest or save money that you do not have. Many people concentrate on how much money they should invest and save, but they often forget how important it is to have a steady source of income initially. Earned income and passive income are the two main sources of income. While passive income is produced by investments like dividends or rental properties, earned money is obtained through working in a job or operating a business. When beginning their wealth-building journey, the majority of people will need to concentrate on earned income because passive income frequently needs upfront money in order to generate returns. It's crucial to take into account your interests and skills while figuring out how to make money. Individuals who are driven to advance in their careers and find fulfillment in their work are more likely to succeed in the long run. Look into vocations that fit your interests and talents, and make investments in training or credentials that will raise your earning potential. Make sure the long-term advantages of school exceed the expenses by keeping an eye on the price of education and any potential student loans. You can lay the groundwork for future wealth creation by earning more money through schooling or career progression. Make a plan and set goals. Setting financial objectives is the next step once you start making money. These objectives will give you a precise roadmap for your desired destination and your route there. To achieve financial success, whether your objective is to buy a home, pay for your children's school, or support your retirement, you must first create clear, quantifiable goals. Establish your financial objectives first. Indicate precisely how much money you'll need and when you expect to finish each task. Determine how much you will need to save, for instance, if you wish to retire at age 65 and lead a comfortable retirement. Ascertain how much you will require for a down payment if you wish to purchase a property. Create a plan to reach your goals after you've established them. This plan can entail investing in assets that will appreciate in value over time, or making a budget to help you save more money. The secret is to maintain your long-term objectives in sight while routinely assessing your progress and making any adjustments to your strategy. Conserve cash. A key component of accumulating wealth is saving money. If you spend all of your money, earning money alone won't make you wealthy. It's critical to set up a structure that guarantees you set aside money from your paycheck on a regular basis. Keeping 3 to 6 months worth of salary set up for emergencies is a common guideline. In the event of unforeseen circumstances like job loss, medical emergency, or home repairs, this offers a safety net of funds. After you have this emergency fund established, you can concentrate on saving for your long-term objectives, like buying a house or retiring. Consider keeping a spending diary for a minimum of 1 month in order to save more efficiently. Organizing your spending into needs and wants will help you find areas where you may make savings. For instance, you may discover that cutting less on subscription services or eating out less often will free up more cash for savings. You can make sure you stay on track by setting a monthly savings goal and automating your contributions through your bank or place of employment. You can establish a solid financial foundation for accumulating money by regulating your spending and saving regularly. Make smart investments. As vital as it is to save money, you should also invest it so that it grows over time. Money tends to lose value over time due to inflation, so even putting your money in a low-interest savings account will reduce your purchasing power. Now is the time to start investing. Diversification is among the most crucial ideas for a novice investor to comprehend. Investing in a variety of asset classes, such as stocks, bonds, and real estate, is known as diversification. Because different assets perform differently in different market conditions, this helps lower risk. Bonds, for instance, can still offer a consistent return during a downturn in the stock market, protecting your portfolio as a whole. Since they combine a range of stocks and bonds, mutual funds and exchange-traded funds, ETFs, offer built-in diversification, making them excellent choices for novice investors. Since index funds usually have lower costs and can provide stable growth over time, they are also a popular option. Index funds monitor a certain market index, such as the S&P 500. Younger investors generally have more time to recover from probable market downturns, so they can afford to take on greater risk. The secret is to build a diverse investment portfolio in line with your financial objectives and risk tolerance. Guard your resources. It takes more than just earning money to build wealth. You also need to safeguard your gains. The worst-case situation would be losing your hard-earned money as a result of unplanned incidents like an accident, natural disaster, or medical crisis. That's the situation with insurance. It is essential to safeguard your assets by putting in place the appropriate insurance plans. While auto insurance pays for accidents, home insurance shields your property from harm or loss. If something were to happen to you, life insurance would guarantee your loved one's financial security. Furthermore, long-term disability insurance might cover your income in the event that a sickness or injury prevents you from working. Insurance may appear like a one-time cost, but it's essential to long-term financial protection. The need to safeguard your assets from unforeseen threats increases as you amass more of them. Reduce the effect of taxes. One aspect that is sometimes disregarded yet has a big impact on your capacity to accumulate money is taxes. You can, however, employ a number of tactics to reduce your tax liability and preserve a larger portion of your hard-earned cash. Utilizing tax-advantaged accounts, such as 401(k)s, IRAs, and 529 student savings plans, is one of the simplest methods to lower your tax bill. With the tax advantages these accounts provide, you can save more money and pay less in taxes overall. For instance, you can reduce your taxable income by making tax-deductible contributions to a standard IRA or 401(k). With some restrictions, retirement withdrawals from Roth 401(k)s and Roth IRAs are tax-free as long as certain requirements are satisfied. Control your debt and establish credit. When it comes to accumulating money, debt can be a double-edged weapon. On the one hand, using credit wisely can assist you in reaching significant objectives, like launching a business or purchasing a house. However, having too much debt can seriously impede your capacity to save and invest, particularly high-interest debt, like credit card balances. It is critical to have a low debt-to-income (DTI) ratio in order to manage debt successfully. Lenders utilize this ratio, which contrasts your income and debt, to determine if you can afford to take on new debt. Your likelihood of being approved for loans with advantageous terms increases with a lower DTI. Since interest costs on high-interest debt can gradually deplete your wealth, paying it off as soon as possible should be your first concern. Additionally, stay away from variable-rate credit cards and loans, which could increase in cost if interest rates rise. Managing your debt also requires you to establish a solid credit history. A high credit score can help you qualify for cheaper credit card, mortgage, and auto loan rates, which can save you thousands of dollars in interest. Pay your bills on time, keep your credit utilization low, and refrain from creating too many new accounts at once if you want to maintain a high credit score. You'll be in a better position to increase your wealth over time if you manage your debt sensibly and keep your credit score high. Recall that the secret to accumulating wealth is to get started early and stick to your plan. Even though failures are unavoidable, you may overcome obstacles and keep moving forward by maintaining focus on your long-term objectives. You may create long-lasting wealth and experience financial freedom for many years to come with perseverance, self-control, and the appropriate techniques. If you found this video helpful and want more tips on building wealth and achieving financial freedom, don't forget to hit that subscribe button and turn on notifications so you never miss an update. Your journey to financial success starts here. Subscribe now.